Welcome to The Explainer. I'm so thrilled you're here today because we're going to unravel one of the most powerful, yet honestly, frequently overlooked secrets of the stock market. Think of the market like this giant, chaotic scene where a million things are happening all at once. In that scene, the price of a stock, well, it's really just a story. It's the narrative everyone's buzzing about. But here's the thing. Stories can be totally fabricated. They can be manipulated. So how do we actually find the truth? We look at volume. Volume is the market's absolute, undeniable truth. It's literally a lie detector that cuts right through all that noise and tells us exactly what's going on behind the scenes.
So let's start with a scenario that pretty much every investor has gone through. Have you ever bought a breakout, feeling absolutely confident that a stock was finally shooting to the moon, only to watch it immediately crash the second you hit the buy button? Yeah, it's painful. It's universally frustrating. You think you're catching the start of this massive rally, but instead, boom, you fall straight into a bull trap. Basically, you got fooled by a fake price move. The price told you a story that just wasn't true. But if you'd been looking at our lie detector, you would have seen that trap from a mile away.
Okay, let's dive into this. There's a stark contrast here that can literally make or break your portfolio. On one side, we have a genuine breakout, and that's driven by high volume. This is a move you can actually trust. On the flip side, we have a dangerous fake out on low volume. That right there is the trap. The difference between success and failure in these moments doesn't come from just staring at the price candle. It comes from looking at the activity happening underneath it. Once you grasp the difference between these two, you stop being a victim of market manipulation and you start trading with the confidence of an insider.
Section 1. The Lie Detector. Decoding Volume. To stop getting fooled by manipulated stock prices, we really need to completely understand our main investigative tool here. The definition of volume is simple, but it's profound. It's the number of shares traded in a given period. Think of it as the market's vote with real money. You see, a stock's price can easily be pushed around artificially by just a little bit of capital in a low liquidity environment. Price can be a total mirage. But volume represents hard cash actively changing hands. It requires serious capital to generate high volume, which means you simply cannot fake it. It's the raw, unfiltered evidence of who is actually participating.
If you take only one thing away from this entire explainer, let it be this golden rule. Never trust a price move not backed by strong volume. Seriously, write that down. Burn it into your memory. Whenever you see a stock suddenly spike, your very first instinct, your immediate reflex should be to look down at those volume bars. If the volume just isn't there to support that price jump, you have to treat that move with extreme suspicion. It's basically a lie waiting to be exposed.
Section 2. The Suspects. Smart money versus small traders.
All right, so if volume is the lie detector, who exactly are we interrogating? Let's break down the dynamics between our two main suspects. When you see a breakout on high volume, you're looking at the massive footprints of institutional investors, what we call the smart money. These are your mutual funds, pension funds, the heavy hitters throwing around millions of dollars at a time. When they step in, they create massive volume, giving us the verdict of a genuine move. You always want to follow the smart money. Conversely, when you spot a breakout on low volume, it means the institutions are just sitting on the sidelines. The folks pushing the price up are small traders, retail investors like you and me. Because they don't have the immense capital needed to sustain a major trend, our verdict has to be that this move is suspicious and probably fake.
I really need to warn you about following small traders into a low-volume breakout. It's a classic trap. As our source material clearly lays out, these low-volume moves typically fail and reverse. Why? Because without that heavy buying pressure from institutional money to absorb the sellers, well, the moment the small traders stop buying, gravity just takes over. The price collapses right back down, leaving anyone who bought that fake breakout holding the bag. Seriously, do not let that be you.
Section 3. The Interrogation Reading Volume in Trends.
So it's one thing to spot a single breakout, right? But it's another entirely to interrogate the ongoing daily trends to figure out if the overall market environment is healthy or if it's dangerous. Here's how you do that. If you're watching a stock and you see heavy volume, specifically on the green up days, that is an incredibly positive signal. It confirms that the buyers are in absolute control and are aggressively stepping in to accumulate shares. That right there is the definition of a healthy uptrend. However, if you start seeing massive, towering volume bars showing up on red, down days, that is a glaring red flag. It means the sellers are in control and major institutions are dumping their shares. That's a dangerous downtrend, and your lie detector is screaming at you to get out or just stay away entirely.
Now, when it comes to the specific moment a stock breaks out above a resistance level, the rules get very strict. A breakout is only a confirmed, genuine move if it happens with 2 times or more the average volume. That massive surge is your undeniable proof that smart money is stepping in. On the flip side, a breakout with below-average volume demands intense skepticism. Now, it doesn't mean it's absolutely guaranteed to fail, but it means you must wait for confirmation before risking a dime of your capital. The lie detector is basically saying the evidence is inconclusive, so keep your money in your pocket for now.
Section 4. The verdict. Confirming the genuine breakout.
Okay, we've gathered the evidence, we've analyzed our suspects, and we know exactly how to interrogate the trends. Now it's time to bring all of this together and render a final verdict. The crucial point really boils down to this magic metric, 2x+. That means double the average volume. If you're looking at a stock breaking through a resistance ceiling, you look straight down at the volume. If that volume bar isn't at least twice as high as the average daily volume over the past few weeks, the breakout is not confirmed. It really is that simple. Institutional money leaves a massive footprint, and that footprint looks like 2x+ volume. When you see that, you know the smart money is driving the bus, and you can comfortably hop on board knowing the move is backed by real, hard cash.
I want to leave you with this provocative thought as we wrap up our analysis of the source material today. Take a look at your portfolio, look at your watch lists, and ask yourself, is your next breakout telling the truth? Now that you have the market's ultimate lie detector right at your disposal, you don't ever have to guess again. You're fully equipped to act as a market detective. Demand the evidence, wait for the volume, and never, ever trust a price move that isn't backed by the undeniable truth of hard cash. Thank you so much for joining me for this explainer, and I highly encourage you to go put this tool to the test in your very next trade.